Welcome to Buzz House, a Baker Tilly podcast. Baker Tilly is a leading advisory, tax, and assurance firm dedicated to building long-lasting relationships and helping you win now and anticipate tomorrow. In this podcast series, developed specifically for professionals in the multifamily housing industry, we'll take an inside look at the topics and issues facing multifamily housing professionals today, tomorrow, and in the future.
Hello and welcome to this edition of Buzz House, our Baker Tilly podcast where you can find all the buzz affecting multifamily housing. I'm Don Bernard, the partner in charge of Baker Tilly's multifamily housing practice, and I'll be talking with my cohort and partner, Garrett Gibson, who also specializes in consulting in multifamily transactions around the country. Today we have a couple of guests in the Buzz House to talk about insurance. I know insurance has been on a tip of a lot of our developer clients' tongues, what's going on. You know, there's been all the natural disasters, the pandemic, and so forth. So very excited to have Brad Winchester and Isaac Bechen, who are co-directors of the real estate and construction group with M3 Insurance, in the Buzz House with us today. So we'll get to Brad and Isaac in a few minutes. Before we have a discussion about the insurance market for multifamily, we do want to touch on recent activity around the moratorium on evictions, which many of you have been probably seeing in the press. The Centers for Disease Control and Prevention, the CDC, took unprecedented action on September 1st by issuing a temporary national moratorium on most evictions for non-payment of rent. And the purpose from the CDC was said to prevent the spread of the coronavirus. You know, citing this historic threat to public health posed by the coronavirus, the CDC declared that the eviction moratorium would help ensure that people are able to practice, quote unquote, safe social distancing and comply with stay-at-home orders. The moratorium takes effect on September 4th and lasts until December 31st of 2020, covering tens of millions of renters that are at risk of eviction. For a renter to qualify for this moratorium, they must provide a signed declaration to their landlord stating a number of items, including things about wages, lack of means to pay the rent, lack of housing options, among other items. One critical component is that no rent or fees are waived as part of this moratorium. Industry groups believe without emergency rental assistance, there could be an estimated 30 to 40 million renters facing eviction come January 1st. Obviously not a great time in winter. Many industry groups are asking Congress to consider emergency rental assistance. We will continue to monitor any legislative activity in Washington for impact on the housing industry and the moratorium and so forth, and we'll report it right here in the Buzz House. Now, Garrett and I would like to jump into a few questions with our guests, Brad and Isaac. Gentlemen, thank you very much, first of all, for joining us today. Brad, would you maybe just start out by giving us just a little background about yourself and M3 Insurance?
Sure. I've been at M3 now for 4.5 years, co-director with Isaac Bechen, who's also on the call, and our two big buckets at M3 Insurance are employee benefits and property and casualty. And on our property and casualty side, we have different industry practice groups that are very specific for our clients and what we do and what we're able to provide. M3 was founded in 1968. We've got 6 offices in Wisconsin and also one in Rockford, Illinois. And one of the big differentiators with us is we are privately owned, so we feel with our national footprint and also our local touch that we are able to pass that down directly to the client.
Thanks for that introduction, Brad. We can go get started too with some other questions. How about Isaac? Let me start with a quick high-level question. So, what is the current state of the market, specifically with pricing? And are there any challenges to getting insured, especially, given the fact that we're in this current pandemic?
Yeah, absolutely. I don't think I'm ready to say that we're all the way into a hard market, but the market is definitely hardening. And it depends greatly on where you're located, age of your properties, and specifically the type of housing that you're looking to insure. Wood frame multifamily built before, say, 1980 or so is going to experience the hardest market that developers and owners have seen in more than 15 years. If the property is subsidized housing, it only makes it that much harder to place coverage. Pricing is definitely up. On average, pricing is approximately 15 to 25% higher than it was this time last year. But in a hardening market, the more concerning elements are the availability of coverage and the terms insurance carriers want to get. So underwriters are depending more on their field inspections. They're holding their ground on improvements needed to older properties, and they're getting the terms they desire, such as higher deductibles and rate increases. The biggest challenge for placing new coverage at the moment nationwide is builder's risk coverage for wood frame projects, especially larger frame projects. Rates are up 100% from 10 years ago, and there are less and less carriers willing to put up large limits on new frame construction. So working closely with your advisor early in the process of the development has never been more important.
Wow, those are definitely some alarming numbers, and we'll get into a little bit later in the discussion what we can do or start to think about that. Brad, a quick follow-up question. Isaac mentioned kind of this hardening market and so forth. I mean, how do we get there? Why are we in this hardening market where we're at today?
Yeah, it's a great question, and it's answering the why behind the what, as Isaac alluded to. Why are clients seeing 15% increases when their portfolios have performed well? And there's really 5 or 6 things that are driving it. The first being the obvious one with all the catastrophic weather events that we've seen across the U.S. On the coast. We've recently with all the fires out west, in the Midwest, tornadoes, wind, hail, it's earthquakes. Everything's kind of come together, and a lot of that is, we're seeing rate increases on the property side. We're also seeing rate increases on auto and umbrella, and increased scrutiny at renewal time with valuations and deductibles, et cetera. There's a lack of alternative capital coming into the marketplace. Reinsurance treaties have increased rate demands. We've seen multiple reinsurers even closing their doors and shutting down. And there's been an increased frequency and severity in overall claim activity. Everything from auto, used to getting a simple fender bender, and what used to be $200 is now $2,000. So it all comes down to the profitability for the carriers and how the end user, the client, is being affected.
And Brad, I would agree with you. I think that's all well said. One additional point I would add is typically insurance companies are okay breaking even on their premium and loss payments, but in a hard market, one of the leading factors is also interest returns. Insurance companies collect premiums, they invest premiums, they receive a return on those investments, and investment returns are down. So when a carrier is not making money on their investments, they need to make true underwriting profit. And as Brad said, with the large catastrophic losses way outweigh premium volume. And on top of it, when you're not receiving good investment income, it leads into a hardening market. And we don't anticipate over the next 2 years that getting any better.
Wow, yeah. Thanks, Isaac, for that. That's interesting. I didn't really think about it in that way. Okay, so given that that's the marketplace right now, what can property owners and developers do about it?
Well, there are a number of things that owners and developers can do to control their rates and get the best terms and pricing from insurance companies. Most importantly, they should be talking with their advisor early and often about upcoming renewals and new plan developments. A hard market also requires that we all kind of get out of our comfort zone. What got us here won't necessarily get us there in today's market. So what's worked for a decade, maybe longer, needs to be relooked at differently. If you insure a schedule of properties on separate policies, you may need to start investigating a master program to take advantage of your size. Carriers still want to write business, so bringing your portfolio together will gain the interest of more insurance companies. At the same time, developers and owners should ask for and consider self-insuring more risk. Not typical to hear your insurance advisor tell you to buy less insurance, but in a hard market, it's time for us to look at things a little bit differently. Master programs can offer a lot of additional coverage. They can even offer great pricing advantages, but it will likely require higher deductibles or self-insured retentions to get to where they want to be from a pricing and coverage structure. As for builder's risk, insurance companies want to take on sophisticated owners and developers paired with the best-in-class contractors. We recommend sharing as much information about the project earlier than they're used to sharing and thinking about their project from an insurance standpoint. In other words, if you were an insurance company, what would make you more comfortable? That means sharing detailed budgets, Gantt charts or timelines, building plans, elevation certificates, and the like, to be as transparent as possible and help the insurance company get comfortable with what is for them a project on paper and some drawings, that these are human beings that underwrite insurance. So getting them as comfortable as possible with what your plans are, who you're using, what that development process is going to look like, is going to get them in the most comfortable pricing and coverage structure that you can possibly get to.
Perfect. Thanks a lot for that, Isaac. And maybe kind of one last question. So we've kind of looked at where we are, what's affecting the markets, and maybe looking ahead into the future. Again, as we talked about, these 15 to 20% rate increases. What are some initiatives that owners, developers of multifamily, what can they think about to kind of plan maybe better for the future, different ideas and so forth? Brad and Isaac.
Yeah, it's a great question, and it's a lot of times it's just getting people to change their viewpoint on how they look at insurance. It's no longer a box to be checked, and while it is important to look at the bottom line, it's what are you really getting out of your premium spend? So for us, it's aligning members of our team with members of a developer, property management team, everyone from the CFO to asset managers, to anybody that touches the insurance. It's one thing, it's great to have reactive claim support, which we're there if something happens, but also proactively. How can we look at properties, loss ratios, sidewalks, roofs? How can we stop claims before they happen? And a lot of that is carrier partnerships with underwriters, resources. And in the end, we want to make your employees better at what they do and taking stuff off of their plate in regards to insurance and getting strategic about it.
Yeah, those are great points, Brian. I would add that I said it earlier, I'll say it again. I think developers and owners need to be prepared to look at their portfolio and their projects differently. They need to get a little uncomfortable and change the way that they've handled placing coverage in the past. One of the biggest trends that we're seeing by insurance companies is the increase in their retentions or deductibles. I think property owners and developers absolutely need to start thinking about, instead of taking what used to be a pretty minuscule or small deductible, and look at self-insuring more of their risk and controlling those losses, those smaller losses, by better in-house risk management, upkeep of properties, maintenance of older buildings, making those improvements that maybe insurance companies have asked for years, such as sprinkler systems or replacing a roof. And while they're added costs, I think most developers and owners will find that those costs are good investments into their projects, rather than investing your money into overhead and premiums and increases that you could otherwise avoid. I think property owners and developers also need to look at alternative risk solutions such as captives. If there's something that they haven't looked at in the past and they're used to buying what we would call guaranteed cost insurance, they transfer all of their risk to an insurance company for a known thing in premium. Alternatively, captives are much higher deductibles or self-insured retentions, but for that risk, in exchange, they receive much lower premiums. So I think as captives have become more prevalent around the country, typically property owners have not utilized captives. And going into this harder market over the next few years, I think it's prudent for most property owners of larger schedules to start looking closely at captives as an alternative risk transfer method. For new construction, we're already seeing a lot of our owners and developers looking at alternative means for their construction. What used to be a wood frame project, because stick wood built buildings are extremely popular nationwide, mostly due to the speed at which they can be built and the cost, they may start looking at alternative construction materials, knowing what the cost is for a wood frame building versus a non-combustible building is dramatic. So I think that we will start seeing, and we're encouraging our owners and developers to have these conversations with their advisors early to look at what's the cost-benefit analysis of using alternative materials to lower the cost of insurance.
Those are all really, really good ideas, and I can, see. I'm taking a lot away from this, and all of our clients are, owners of multifamily properties, and a lot of really good considerations. So thank you, Brad and Isaac, for joining us today, sharing. Newest people, again, probably, I don't know, people might be shocked, maybe they're not shocked by their increases they're seeing, but obviously a lot of good planning we can do around this. So again, thanks, Brad and Isaac, for joining us. Listeners, thank you for tuning in today as well. As always, feel free to reach out with any questions about today's podcast or to brainstorm on your multifamily development. Also, please check out bakertilly.com for many resources continuing around the COVID-19 pandemic. If you have any suggested topics, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.
Thank you for joining us today. To receive notification when new episodes become available, please subscribe to Baker Tilly US wherever you get your podcast.